America is collapsing, and it starts with your home. Over 3.8 million homeowners are behind on their mortgage. More than 11 million renters are at risk of eviction. Property taxes are rising faster than wages in 90% of U.S. counties. And housing insurance? Up 35% nationally, with some states seeing hikes over 100%. You think you're safe because you own your house? You're not. Your mortgage, your utilities, your taxes, your insurance, they're all traps now. And once one snaps shut, it drags down everything. Your savings, your credit, your retirement, your future. This isn't a prediction. This is what's happening right now in neighborhoods just like yours, to families just like yours. So before you think, that couldn't happen to me, let me show you exactly why it already is. Your mortgage isn't fixed. It's a time bomb. People hear fixed-rate mortgage and think they're safe. But here's the part no one talks about. Your escrow isn't fixed. And right now, across America, property taxes and insurance premiums are exploding, turning stable payments into monthly nightmares. In states like Florida and Louisiana, homeowners are watching insurance costs double or even triple because major insurers are pulling out of disaster-prone zones. Farmers, State Farm, Allstate, they're either gone or hiking rates so high that middle-class families are being priced out of their own homes. Why? Because 2023 and 2024 saw record-setting climate disasters. $92 billion in weather-related insurance claims in 1 year. That's the most in U.S. history. And insurers aren't eating those costs. They're passing them to you. And that means your mortgage company, which handles your escrow account, is about to hit you with a reassessment. Your $1,800 monthly payment, it becomes $2,300 overnight. And if you can't pay it, you're in default. You're not late. You're in foreclosure proceedings. And here's the kicker. This isn't just happening in flood zones or wildfire states. This is happening in Ohio, in Texas, in North Carolina, where taxes are spiking to cover municipal shortfalls and bloated pension obligations. Your forever home just became unaffordable, and there's no legal cap on how much they can raise your escrow. You signed the mortgage thinking you locked in your housing cost. But in 2026, your cost of ownership is anything but locked. It's a ticking financial grenade. And when it explodes, most people won't even know what hit them. One day, the payment bounces. Then the warnings start. Then the notices. Then the sheriff's sale. And once that starts, good luck getting another mortgage anytime in the next decade. The system doesn't care why you fell behind, just that you did. And it's happening right now to millions, quietly, invisibly, until it's too late. Airbnb turned your neighborhood into a ghost town and a bubble. Remember when Airbnb was just a way to make a little extra cash? That's over. What started as side hustle has become a shadow housing market, one that's imploding in real time and taking entire neighborhoods down with it. Right now, over 40% of new home purchases in some cities are made by investors, not families. And a shocking portion of those are being turned into short-term rentals, flooding places like Phoenix, Austin, Nashville, and Denver with thousands of homes that aren't really homes. They're mini hotels with no front desk. And now that travel demand is softening and the algorithmic booking frenzy is dying, these hosts are discovering that they can't cover their mortgages. That $700,000 suburban McMansion they turned into a weekend party palace, it's sitting empty. Multiply that by tens of thousands and what you have is an artificial housing glut, not in supply for families, but in speculative listings for a tourism economy that's drying up. Airbnb revenue per unit is down nearly 45% in some markets year over year. And now, cities are cracking down. New York banned short-term rentals under 30 days. Dallas is next. More than 70 cities are rewriting local laws to ban or restrict Airbnb, which means hundreds of thousands of properties are about to be dumped back on the market, but not at affordable prices. These homes were bought with inflated valuations and financed at 3% interest rates. Now, refinancing at 7.5% makes the math impossible. These owners can't rent long-term and can't sell without losing money. So what do? They walk away. It's already started. Foreclosures are creeping up in Airbnb hotspots. Lenders are panicking. And buyers? They're watching as entire neighborhoods, once lively, become eerie rows of empty homes with lockboxes and dying lawns. It's 2008's investor bubble, but this time it's dressed up as hospitality. And the unwind is already here. Rent is becoming the new subprime, and it's breaking the system. If you thought the 2008 crisis was about home ownership, think again. The real crisis of 2026 is happening in rental housing, and it's eerily similar to the subprime meltdown. Except this time, it's the landlords who are over-leveraged. Here's what most people don't know. In the past 3 years, institutional landlords have bought more than 700,000 single-family homes, often using borrowed money at dirt-cheap rates. Now, with interest rates soaring, these landlords are watching their profits vanish. Companies like Invitation Homes, American Homes for Rent, and countless regional players are bleeding cash. Why? Because rents are flatlining, vacancies are rising, and delinquencies are surging. According to TransUnion, rent non-payment has jumped 32% year over year for Class B and C properties, the very units working-class Americans live in. That means the landlords can't pay their loans, they can't refinance, and they can't sell without losing millions. But it gets worse. Many of these rental portfolios were bundled into residential mortgage-backed securities, RMBS, the same kind of toxic financial products that triggered 2008. And those securities, they're starting to default, not theory. It's happening right now. The delinquency rate on institutional rental-backed bonds just hit its highest level since they were created. This isn't a crack, it's a fissure. And when it breaks, it'll take down not just investors, but tenants, millions of them. Evictions are up over 40% in some states, with housing courts backed up for months. Cities aren't ready, shelters are already full, and the wave hasn't even crested. The irony? Renting was supposed to be safer than owning. But in 2026, the rental market is a financialized Ponzi scheme, teetering on the same kind of leverage and delusion that crashed Wall Street in 2008. Except this time, you can't just sell. You get evicted, you sleep in your car, or you move into a hotel room with your kids. That's what's happening. And the collapse is just beginning. The suburbs are financial traps, and no one's talking about it. We used to think of the suburbs as a financial upgrade, a place where families could stretch out, raise kids, own something. But in 2026, the American suburbs have become financial prisons, and nobody's warning you. These homes were bought in 2020 through 2022 during the pandemic frenzy, when 30-year fixed mortgage rates were at 2.5%. But guess what? That same house is now worth less than the mortgage, and the owners are stuck. They can't refinance. They can't sell. They can't even move. Why? Because wages haven't kept up with inflation, interest rates are over 7%, and nobody is qualifying for new loans. Even worse, local governments, desperate for revenue, are jacking up property taxes across the board. School levies, infrastructure fees, new utility charges, everything. And with housing values declining, that means you're paying more for a less valuable asset. Welcome to negative equity. But here's the part nobody mentions. Suburban cost creep. You move out thinking it'll be cheaper, but everything costs more. Gas, commutes, childcare. You're paying $2,500 a month just to maintain the illusion of stability, and it's bleeding people dry. Homeowners associations, HOAs, are collapsing under budget shortfalls, raising fees to cover decaying infrastructure. Yet you still have potholes and brown grass. In many subdivisions, over 30% of homes are rentals now. That means less community, more turnover, and more absentee landlords. Crime rises, values drop, and your dream home becomes a slowly rotting liability. You can't downsize because nobody's buying, and you can't walk away without destroying your credit. So you grind it out, cut the grocery budget, skip vacations, pray your furnace doesn't die. This isn't wealth building, it's entrapment by amortization. A slow-motion foreclosure you don't see coming until you're underwater, again, and millions are already there. Suburban America is quietly turning into the new silent poverty class. Nice lawns, newer cars, no cash, no safety net. The numbers don't lie. A recent Freddie Mac survey shows 63% of homeowners would struggle to cover a $400 emergency. And these are people with 3 bedrooms and 2-car garages. The crash won't start in cities this time. It's going to start in gated communities, in cul-de-sacs, in subdivisions built in 2015, where the math no longer works and the owners are too scared to admit it. That's what's coming next. Starter homes are dead, And so is the middle class. Ask any millennial or Gen Z couple in 2026 what they want most, and you'll probably hear this. A small house we can actually afford. Sounds reasonable, right? A modest home to raise a family in, build equity, escape rising rents. Well, here's the truth. Starter homes don't exist anymore. Not in any meaningful way. Not in any place you can actually live, work, and raise a kid. The supply is gone, replaced by luxury units and investor portfolios. The National Association of Home Builders reported that only 7% of new single-family homes built in 2025 were under 1,400 square feet, the traditional definition of a starter home. And the ones that do exist? They're priced like mansions. The average home in a modest suburb? $436,800. That's 70% higher than it should be based on inflation-adjusted 1992 prices. And worse, even if you could afford that, you probably couldn't get the mortgage. Lending standards have quietly tightened as banks prepare for the next wave of defaults. The result? Entire generations are locked out. So what do? They rent, except rent's unaffordable too. So they live with parents, or roommates, or in RVs, motels, or God help us, cars. We've created a permanent underclass of working professionals who will never own property. And that's not accidental. It's policy. Wall Street firms are now the largest landlords in America. BlackRock and Invitation Homes aren't selling, they're buying. And they want to keep you renting forever, because every rent check you send is passive income for someone else's portfolio. The American dream has been turned into a subscription service, and you're the product. Want to know how bad it's gotten? A 2025 Zillow analysis found that in 99% of U.S. counties, the average teacher, firefighter, or nurse can't afford the average home on their salary. Let that sink in. You can save, budget, work full-time, and still never have enough for a down payment. That's not failure. That's a rigged system, a trap, and millions of Americans are waking up to it. The dream of owning a starter home isn't just delayed, it's dead. And with it, the financial foundation of the American middle class is collapsing in real time. No property means no equity. No equity means no leverage. And no leverage means no future. Utility. Costs are becoming the new foreclosure trigger. Forget mortgage rates. Forget home prices. You want to know what's quietly tipping millions of Americans into default in 2026? Electric bills, water bills, sewer surcharges, garbage fees. The basic utilities you need to keep a house livable are turning into financial torpedoes. According to the U.S. Energy Information Administration, residential electricity prices rose 18% between 2021 and 2024, and the trajectory hasn't slowed. Natural gas? Up over 50% since the pandemic, especially in cold weather states like Illinois, Pennsylvania, and Michigan. Meanwhile, municipal water utilities, desperate for revenue, are hiking rates by 20 to 30% annually in some cities. You used to budget $200 a month for utilities. Now it's $500, and you haven't changed anything. But here's the sickest part: late fees. If you're one day late, that $128 electric bill is now $146. Wait another week, they tack on another $35 reconnect fee. Miss 3 payments, you're cut off, and the moment your utilities are shut off, you're in violation of your mortgage contract. You're now legally in default, even if you're up to date on the mortgage itself. Lenders can and will use that to begin foreclosure proceedings, and this is already happening. In Texas and the Deep South, more than 22,000 utility-related foreclosure filings were initiated in 2025 alone. The numbers are exploding in poor and working-class counties. Why? Because energy isn't optional. You can't not pay, and they know it. Even worse, smart meters now let companies remotely shut off your power without sending a technician. One wrong click, and you're literally in the dark. A report from the American Public Power Association found that 17 million households were behind on utilities at the start of 2026. That's more than 1 in 8 homes. And the average balance owed? $789, not thousands, not tens of thousands, just $780. And yet that's enough to push families into eviction court, bankruptcy, foreclosure, not because they were irresponsible, but because they couldn't afford heat and light, the most basic functions of modern life. In a country this rich, people are losing homes over water bills. Let that sink in. The next wave of the housing crisis isn't about credit. It's about survival, and it's already here. Local governments are about to trigger the next housing collapse. Everyone keeps looking at Wall Street or the Federal Reserve for the next crash. But let me tell you the truth no one wants to hear. Your local city council might bankrupt you before Jerome Powell ever does. Why? Because across America, cities are broke. Not kind of broke, not tight budget broke. I'm talking pension systems teetering, infrastructure collapsing, and public debt exploding. And they're coming for your house to pay for it. In 2026, cities like Chicago, Baltimore, St. Louis, and Oakland are massively underwater on their liabilities, mostly due to unfunded pensions for police, firefighters, and teachers. So what do they do when they're out of options? They do what they always do: raise property taxes. And it's happening fast. In Cook County, Illinois, tax bills jumped 46% in 2025 for some neighborhoods. In New Jersey, homeowners are seeing annual increases of $2,000 to $3,000. And for what? Crumbling schools? Empty libraries? You're not paying for services. You're paying for decades of political failure. And they're not stopping there. Water fees, streetlight surcharges, stormwater assessments, trash collection upgrades that now cost $700 a year. Even driveway taxes in some cities. Every inch of your property is being monetized like a corporate asset. And if you miss a single payment, they can put a tax lien on your home, and you could lose it even if your mortgage is current. In 2025 alone, more than 62,000 American homes were auctioned off due to tax delinquency. Not foreclosure, not unpaid mortgages, but unpaid taxes. Some as low as $300 in missed payments. And guess who's buying them? Hedge funds and private equity firms that specialize in tax lien arbitrage. They pay off your debt, take your title, and flip the home or rent it back to you at a premium. And it's completely legal. This is the next wave of theft, municipal foreclosure, coming not from a bank, but from the town you've lived in for 30 years. The same one that now treats your home like a line item on their spreadsheet. People think they own their homes. But if you can lose it over a tax hike you didn't vote for, you never owned it in the first place. You were renting from the state. Insurance is becoming optional until disaster strikes. You know what's scarier than inflation, layoffs, or rising rates? Waking up one day in 2026 and realizing your home isn't even insured anymore. Because that's what's happening right now, in one of the most underreported crises in America. Homeowners across the country are being dropped by their insurers, or priced out entirely. And once that happens, you're just one storm, one fire, or one burglary away from complete ruin. Let me show you the math. In Florida, 12 major insurance carriers pulled out of the market entirely by 2024. In California, State Farm and Allstate have stopped writing new homeowner policies altogether. In Louisiana, premiums have doubled or tripled since 2022. Why? Because climate risk is now uninsurable in huge swaths of the country. Wildfires, hurricanes, flood zones. Even basic storm coverage is disappearing. Actuarial tables can't keep up, and reinsurance costs are skyrocketing. What this means is that millions of Americans are living without any coverage at all. FEMA estimates that as of 2026, 13.3 million homes across the U.S. are currently uninsured or underinsured. And don't assume you're safe just because you have a mortgage, because many lenders now accept bare minimum coverage or force-place insurance that protects them, not you. Think you're covered? Read the fine print. That fire policy may exclude electrical faults. That flood coverage may exclude everything except rising water from federal channels. That's legalese for good luck. But here's the nightmare scenario. Say you do get hit. Your roof tears off in a storm, a fire guts your kitchen, or a tree takes out your garage. You file a claim and suddenly discover the deductible is $18,000. Or worse, the insurer says the damage was preventable and denies the claim outright. That's happening every day now. It's not just unaffordable, it's unreliable. And what happens if you can't get coverage at all? You're in breach of your mortgage terms. Lenders can call in the loan or force you into high-interest replacement coverage that costs 10x more than market rates. Can't pay? You lose your home. So in 2026, insurance is no longer peace of mind. It's a luxury, a gamble. And in an economy already on edge, it's the last card standing between middle-class stability and total collapse. The collapse of confidence is already here. You just haven't felt it yet. Most people think economic collapse looks like fire and fury. A stock market crash, a wave of layoffs, a run on the banks. But in 2026, the most dangerous collapse isn't explosive. It's silent. It's a collapse of confidence, and it's already infecting every level of the American housing system. Slowly, invisibly, until it all snaps. Here's what no one tells you. Housing is built on trust. Trust that your home will be worth more next year. Trust that buyers will show up. Trust that the government will back your loan, that insurance will protect you, that interest rates will stay stable. But right now, that trust is gone. Just ask mortgage lenders. According to the Mortgage Bankers Association, application volume has plunged 66% since 2021. That's the lowest in 30 years. Builders are walking away from projects mid-construction. Appraisers can't price homes because there are no recent comps. Homeowners are frozen. Buyers are afraid. Sellers are desperate. It's not a housing market anymore. It's a standoff. And the government? They've quietly stepped back. The Fed isn't cutting rates. They can't. Inflation is sticky. Meanwhile, FHA defaults are rising fast, with early-stage delinquencies up 29% since 2023. They're bracing for a wave they can't stop. Fannie and Freddie are backstopping loans that are already sliding underwater. And worst of all, foreign buyers are pulling out. China, Canada, the UK, all cutting US real estate exposure. Institutional confidence is dead. And when belief dies, markets die. That's the part most people forget. The Great Depression didn't start with mass layoffs. It started when people stopped buying, when banks stopped lending, when investors stopped believing things would recover. Confidence is the oxygen of capitalism, and we're suffocating in real time. Look around. Ask your neighbors. Do they feel confident or exhausted? Angry? Scared? The confidence collapse doesn't show up in headlines, but it shows up in empty listings, stagnant wages, vanishing retirement accounts, and the eerie silence of streets that used to be alive with growth. When confidence collapses, people stop building, stop spending, stop moving, stop dreaming. And once a nation stops dreaming, the crash isn't coming. It's already here. The new American homeless, middle class, educated, and employed. Forget the stereotypes. In 2026, homelessness has a new face. She's a preschool teacher with 2 degrees. He's a retired vet with a pension. They're a couple with full-time jobs and kids in school, and they live in a car, a motel, or a tent because America no longer has a place for them. This is the most devastating truth of all. Millions of Americans did everything right and still ended up with nowhere to go. They worked. They saved. They didn't buy yachts or gamble in crypto. They just wanted a home. And now, after years of rising costs, wage stagnation, housing shortages, and relentless inflation, they're priced out of the very neighborhoods they built. The data is horrifying. As of Q1 2026, over 1.4 million public school children are classified as homeless, the highest on record. Extended stay motels across the country are booked solid, not by tourists, but by entire families who live week to week on $2,500 rent, with no lease, no equity, no rights. You think homeless means sleeping under bridges? No. It means your coworker sleeping in their SUV behind Walmart, taking baby wipes showers, praying no one notices. Even worse, eviction courts are swamped. A single missed payment, rent, utilities, taxes, can set off a chain reaction that ends with everything gone in 60 days. And with affordable housing supply down 75% from 2011 levels, there's nowhere to go. Section 8 waiting lists, closed, shelters, full, government relief, a cruel joke. People are resorting to GoFundMe campaigns just to survive another week. And the shame? It's unbearable. People don't tell their families. They lie to coworkers. They park in different lots every night. America's middle class is imploding in silence while politicians argue over nonsense. This isn't a fringe issue. This is mainstream poverty happening in real time. And if you're not feeling it yet, just wait. Because you're one job loss, one medical bill, or one tax increase away from joining them. That's not alarmism. That's the mathematical reality of 2026. This is what collapse really looks like. Not with riots and fires, but with quiet resignation. People disappearing from leases, from jobs, from dignity, from the illusion that America still works. Because millions of homes are at risk, but millions of lives already are.